Good morning, Ian. Many thanks for taking the time to talk to us today.
Good morning.
So, a very strong trading update. What's behind the significant year-on-year increase?
Yeah, so we're very pleased to be able to issue a strong trading update just after the year end. And I think what's behind it is the buy and build plan that we've been executing over the last 3 years, where we've been putting together a group of companies that provide what we think is the full range of finance products that SMEs require. So that's asset finance, vehicle finance, loans, and invoice finance. And I think that some of the growth has come from the acquisitions. So last year we acquired Generate Finance, Positive Cash Flow Finance, and Car Finance to You. But pleasingly, and perhaps more importantly, there's been organic growth of over 30% year on year from the companies that we had in the group already. So very pleased with that performance. And of course, that growth in revenue, that's over 75% year on year, has come through to the bottom line, which reflects an improvement in the earnings per share, which hopefully our shareholders will be very pleased with.
And does the revenue increase suggest that business conditions for lending to UK SMEs continues to be favourable?
Yes, it does. The industry is favourable for us. We focus on the smaller end of the SME scale in terms of the companies that we lend to, and they've proven to be very steady and very resilient during the course of the year. And that's enabled us to increase our origination to over 140 million because of, firstly, having a range of products that I mentioned earlier, but also because of the hybrid model, as we call it. That's the ability to fund the business on our own balance sheet and to broker onto other lenders, where we've been able to optimise the amount of business that we can generate from what, as I say, is a very steady and stable sector.
And you refer to over 50% of current year revenue being held in unearned income. Can you expand on that visibility?
Yes, so the point there is that the business that we write on our balance sheet is typically over 3 years on average. So what that means is that in the balance sheet at year end, we have receivables that we'll collect over the future 1, 2 or 3 years. And obviously we're charging interest on those receivables. So we can see that we have a good proportion of next year's revenue already held in the deals that we've written. I mean, the point there is that we have to collect those receivables, of course, and we're confident in doing that. As we reported in this update, our bad debt write-off position is still very low, at around 1% of the overall portfolio, which is consistent with previous years. So we're very pleased with that performance of our receivables.
And you mentioned revenue slightly ahead of expectations and profits in line. So that suggests higher costs in the year. Is that the case?
Yes, we have incurred some additional costs during the year. And what we've done in putting the group together is acquired some companies that have been quite small, and we've needed to invest in their infrastructure in order to bring them up to the standard of control and governance that we would expect. So a good example is the compliance function, where a year ago we had essentially one person in that team. We now have a team of 4, having recruited a head of compliance from the Financial Conduct Authority. And that's an example of where we built infrastructure into the group in order to meet the standards that we set. And additionally, we've improved and increased our sales resources to ensure we have the right foundations for growth in future years.
In terms of borrowing facilities, you mention a significant increase and lower costs of borrowing. Is that simply the scale of the group that brings the benefit of lower cost of funds, or is that something else?
It's 2 things, actually. I mean, most of it is the scale, in the sense that we're able to ask for higher levels of borrowing each time we draw down some money, which gives us economies of scale and allows us to command a lower cost of borrowing. And that also allows us to attract new facilities, such as the British Business Bank facility that we announced a few weeks ago. But in addition to that, we have had the addition of the commercial finance division that came into the group during the course of last year. And the cost of borrowing for the facilities in that division are lower than we've historically had in our leasing and loans division. So the blended effect of those increased facilities is now a lower cost of funds.
And in terms of the integration of acquired businesses, is this now complete, or are there further synergies to come?
Yes, so the integration is partly complete in the sense that we've completed the integration of back office procedures, as we call them. So that's the accounting function, human resources, compliance, underwriting and marketing. And we're in the course of completing what we call our Platform One project, which is the systems integration that will be implemented during the course of this calendar year. And we expect to get further synergies from that project. And then in addition to that, I'm pleased to say that our cross-selling efforts are now yielding new business deals on a month-to-month basis. And that's an important aspect for us going forwards with our range of products, and that we're able to cross-sell products from one part of the group to another.
So how do you see the business developing and the outlook for the full year 2019?
Well, we'll continue to focus on the organic growth that we delivered during the course of the last 12 months. We see opportunities for strong further organic growth from the group of companies that we've put together. We see further synergies coming from our Platform One project and from operating on a group-wide basis. It's a very fragmented sector. There are M&A opportunities out there, and we will look at those from time to time as they arise, but there's no particular projects that we're looking at this particular time. So the focus will definitely be very much on organic growth from having the range of products that we have at our disposal, and focusing on the smaller end of the SME sector as we've been doing the last 2 to 3 years.